Solo 401k, owner onlys, solo Ks, all the same thing. And they're one of the best ways to save for retirement if you are self-employed. In this video, we are going to go through 6 questions covering the basics and a few advanced strategies that can supercharge your savings. What is a solo 401k? It is a retirement plan for self-employed individuals or business owners with no full-time employees. The individual in this situation acts as both the employer and employee, and now this means that the person sponsoring this plan can contribute from both sides, the employee contribution and the employer contributions. Now then,
the shortest team meeting in the world.
Hopefully, all right. You agree with this? Yes, I agree with this. Okay, good. We're ready to go. Now then, because there is no such thing as an owner K. There's no such thing as a solo K. There's no such thing as all those other words we wrote. We said before, okay? There's 401k plans. But what's different is if you have no full-time employees and you're the owner of the company, you don't have to file a 5500 until you have $250,000 in the plan, okay? All your other rules, they're all the same, okay?
Except you're really not in a ERISA plan.
Well, yes, but your limits, the things you have to follow, you have to have an adoption agreement, the loan limits, every other rule is exactly the same. Now then, who can set these up? Essentially everybody, sole proprietors, single member LLCs, partnerships, S Corps, C Corps, basically everybody but a not-for-profit, okay? As long as you don't have any full-time employees other than you and possibly your spouse. If you have a full-time employee, eventually they're going to be in the plan. Okay?
Marry them.
And we're not married. What can you contribute in this? All right, we've got the brand new limits for 2026. Yay, the new limits are here. Okay, so the employee deferral is the same up to the annual 401k limit. So for 2026, it's $24,500, and it's an $8,000 catch-up if we're doing 2026. It's an $8,000 catch-up if you were born in 1976 or before. The employer contribution is still up to 25% of net earned income, and if you're self-employed, that's approximately 20% of gross. Now then, your total is 80 grand if you're 50 or older. Okay. Why is this better than other retirement accounts? There are higher contribution limits than IRAs. Okay. You can have tax-deferred growth, or your 401k plan can have the Roth option.
All in the same plan?
All in the same plan.
All.
It's not a separate plan.
It's all in the same plan?
One plan.
Yep.
You have one plan with pre-tax.
One plan to rule them all.
Roth deferrals. And you can have tax-free withdrawals if you follow the Roth options. You get full control over the investments, and of course you get full control over plan design within the limits of the rules and the law. Now then, because of catch-up and deferrals, you have there are lower compensation limits needed to maximize your contribution than compared to a SEP. Now then, there are a few rules that you need to know, all right? If you have any employees, that could be part-time, somebody working 1 hour a year, or you're a corporation, or basically most owner-only plans, you need to get the plan set up and the first deferral deposited by December 31st. Okay, well, or like this January 2nd or 3rd, but you got to get the plan signed up by December 31st for most people if you want to make a employee deferral for the year you're setting up the plan. Okay, you can decide on what your employer contributions are later. Now then, there's a special new rule in Secure 2.0 for certain sole proprietors, and we mean that as a tax status, not S Corps with no employees. Okay, we're talking about the sole proprietor tax status, not partners, not LLCs, not LLPs. Sole proprietors with 0 employees can set up their 401k plan early in the following year for deferrals and employer contributions for the prior year. Okay, it's a very, very small group of employees that can do that.
As long as they haven't filed their tax forms, right?
As long as they haven't filed their tax forms, correct. Employer contributions can be made until your tax filing deadline if you've extended your filing deadline. And you do not have to have an annual Form 5500 until your assets exceed
$250,000.
$250,000. Are there, some quick advanced strategies?
So you can have a solo 401k and a solo cash balance plan.
Right. You can
Put away a lot of money.
More money. Yeah. You don't have to have employees to have a cash balance plan. If you're a boomer and you don't have anything saved, talk to us about doing a 401k plan with a cash balance plan.
And Roth is an option in your solo 401k.
Right.
And that's what's amazing about that is there are income limits in IRAs.
Roth IRAs.
But not in Roth, not the same.
Not in a 401k plan that lets you make a Roth deferral, okay? And there's also something called a mega backdoor Roth. This is where you use after-tax contributions, not the same as Roth deferral. After-tax contributions. By the way, we need a whole separate video of why this only works for owner-only plans. This does not work if you have rank-and-file employees in your plan, all right? Also, what else should they know, dear?
Hey, we do some other things like the 401 Couple podcast and the Planarchy podcast,
Right. So
all on YouTube,
multiple
Spotify,
YouTube channels,
many places.
Spotify, Apple Podcast, Instagram, the whole shot. So click on the link below to find out about that. And if you have any specific questions about your plan, please just email us at sales@hunterbenefits.com. Like, subscribe, you know what to do. And of course, don't forget to keep those cards and letters coming.
Toodaloo.